This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Home sweet home. The overall pace of new home sales remains near a 6-year high despite a slight drop in January. But it's home improvement projects that are really picking up.
Target's transformation. Are consumers responding to the big changes being made by the retailer's new CEO?
Playing politics. That's what some House lawmakers accused Federal Reserve Chair Janet Yellen of doing. And her testimony today turned contentious. All that and more tonight on Nightly Business Report for Wednesday, February 25th.
Good evening, everyone, and welcome. The Dow Jones Industrial Average eked out another record close, but it was housing and how hope may still spring eternal for the housing market that got everybody's attention. Today, there were some positive signs for the sector, which has lagged the overall economy since hitting a speed bump more than a year ago. Sales of newly built single-family homes fell only slightly in January, despite all that snow in the Northeast, while supply, which has been tight, rose to its highest level since 2010. The pace for sales for December was also revised higher. Tight inventories and a lack of wage growth had been holding housing back, but now the labor market seems to be gaining some steam, and home builders say that they are seeing more traffic.
Well, it's not just home builders seeing more traffic, but also home improvement retailers. Today, Lowe's reported better than expected fourth quarter results, driven by more homeowners taking on big and not so big renovation projects. Shares, however, did fall a fraction after the company expressed concern about rising interest rates potentially impacting prospective home buyers. Still, the company does expect existing homeowners to continue to invest in projects and upgrades for their houses. Diana Olick has more now on what's behind the surge in remodeling.
Rising home values are pricing buyers out of today's housing market, but they are also giving homeowners more confidence to invest again in their properties.
As soon as we start seeing the housing market recover, people get confident. Not only do they tackle the renovations they want to, but they address the maintenance that it needs as well.
Projects large and small.
We have more projects, more proposals out than ever before.
Architect Matt Osolinsky is seeing a steady business on the high end, but more growth in smaller projects and remodels in less expensive homes.
I think the reason why we're seeing the increase on the lower end is because people are feeling more confident in the economy, more confident in their spending ability, more confident in making investments in their homes.
While full recovery in residential construction is many years away, the home improvement industry could post record-level spending in 2015, according to Harvard's Joint Center for Housing. Remodeling building permits rose 6% in January month-to-month, according to BuildFacts. Why? People who didn't move because of the housing bust are now improving their current homes, maybe even preparing them to sell. Some are doing much-needed maintenance that they had deferred during the penny-pinching recession. And there are also new federal and state stimulus programs for energy-efficient upgrades. While kitchen remodels are always the most popular and do return the best value, today's trends are being driven by those who can't afford to move. Growing families, adding another bedroom upstairs, and baby boomers doing the same thing on the main floor so they can age in place.
That's a big change in what I see in our market in the last, say, 2-3 years.
And given an ever pricier market, one that is likely to grow even more. For Nightly Business Report, I'm Diana Olick in Washington.
Today's choppy trading session was just enough to help the blue chip average finish at an all-time high. By the close, the Dow Jones Industrial Average closed at a new record of 18,224, a gain of 15 points. The Nasdaq fell less than 1 point, thereby breaking its winning streak. The S&P 500 also off by a point. And the yield on the 10-year, it stayed below 2%.
Federal Reserve Chair Janet Yellen was back on Capitol Hill for her semi-annual report to Congress on the economy. But today's hearing in front of a House panel was much more contentious than yesterday's Senate appearance and much more political. Lawmakers accused Yellen of meeting with the White House more often than with Congress and with Democrats more often than with Republicans.
As far as meeting with outside liberal organizations, I wonder whether you can agree today that you will meet with folks from the other side on the spectrum and meet with some of them who have a different view on this.
I'm sorry, we meet with a wide range of groups. I think it is a complete mischaracterization of our meeting schedules, and my meetings are entirely public. My schedule is completely in the public domain.
Well, that's where I'm actually taking this from. This was just handed to me, so
I'm
it's good
sorry,
that
but I think if
it's
you
good that
have-
this much of it is in public domain. Would you make available the transcripts or summary of those meetings that you have? You didn't answer that question to the chair. Would you make those summaries available?
These are private one-on-one meetings, and I don't think it's appropriate. If I had breakfast with you, I would not make a transcript of what we discussed.
Lawmakers also questioned the timing of her speech on income inequality, which was given in the midst of last fall's congressional campaigns.
And tensions were also high at another Capitol Hill hearing, this one on the internet and how it should be regulated. Tomorrow, the Federal Communications Commission will vote on new and very controversial rules that propose to regulate broadband pretty much like a utility. And today, some of those who oppose it got one more chance to make their opinions heard. Julia Borston has more.
The Federal Communications Commission is expected to approve 3-2 net neutrality rules to ensure that internet providers treat all content equally and can't charge for prioritization. And in a key change, these new rules would regulate the internet as a public utility. While internet companies from Netflix to Facebook and internet providers, including Comcast and Verizon, largely agree on the principles of net neutrality, they disagree on regulating the internet under what's called Title II regulations, the same way phone companies are regulated. Internet companies say the rules protect consumers. Internet providers say it raises the risk of government overreach.
You have the companies like Verizon and AT&T and Comcast who are saying that they don't oppose any of the net neutrality related rules, but the legal framework in order to get there imposes all of these burdensome regulations.
Thursday's FCC vote comes on the heels of a House subcommittee hearing in which Republicans opposed net neutrality rules.
What the FCC is probably going to vote on tomorrow is net nonsense,
saying it will lead to years of uncertainty for companies and consumers. Congressional Republicans who appealed to the FCC to delay the vote say legislation is the best solution. If the vote goes as expected, this battle is far from over. Entrepreneur Mark Cuban is an outspoken opponent of the proposed regulation.
I think net neutrality is the dumbest stuff ever. Really, the base of net neutrality is not a technical argument. It's not a business argument. It's purely and simply a demonization of a couple big companies.
Cuban and industry watchers say plenty of lawsuits are on the horizon.
I think the key question here is really part of this collateral damage conversation is this really a foot in the door towards price regulation of the broadband market?
The FCC says it has no plans to regulate pricing. For Nightly Business Report, I'm Julia Borston in Los Angeles.
New developments to tell you about in that Homeland security standoff. Senate Democrats have agreed now to a proposal by Majority Leader Mitch McConnell to vote on two bills, one that will fund the agency and another on the president's executive order on immigration. But at this time, it is still unclear how the House will respond.
To earnings now, and Target, which reported its best sales growth in about 3 years today. Sales excluding newly opened and closed stores rose nearly 4% for the fourth quarter. That's ahead of projections, and profits beat Target's own forecast. Shares rose modestly to $77.15, sitting just shy of a 52-week high. Courtney Reagan takes a look at the big changes made under the new CEO and what's ahead for Target's transformation.
So far, so good. In his second full quarter as Target's CEO, Brian Cornell led the retailer to earnings and sales above even the company's updated forecasts. Comparable sales turning in the strongest result in 11 quarters, thanks in part to the redemption of gift cards purchased over the Black Friday weekend.
When we think about this connection of stores and digital, the important point is it's not either or, it's an and.
Two of Cornell's bold moves include exiting Target Canada after opening stores less than 2 years ago, and this week cutting the free shipping threshold in half to $25. In a CNBC exclusive, Target's chief financial officer, John Mulligan, said the cost of lowering the free shipping threshold is more of an investment because Target shoppers that buy both online and in store are more valuable than consumers using only one shopping channel.
automatically we get more sales because they're shopping online, but they actually increase their engagement with us in the store as well. So we see a significant increase in both sales and gross margin dollars or profitability from that guest.
There are also more subtle initiatives Cornell is working on to bring in shoppers and enhance their loyalty to the retailer, particularly moms.
Every time I talk to Target moms, they have stories about coming to our stores when they had their first child, memories they have about shopping, and we want to make sure we reinforce that. It's something we've got to be famous for.
If Target can make shopping the brand a habit for the growing millennial mom generation, Wolf Research suggests Target's earnings will be a positive beneficiary. In a Wolf Research survey, Target is the strongest brand among mothers with young children, a group who shops stores frequently and is less likely to substitute shopping at Target with online options. But the initiatives aren't free. There's a cost associated with keeping digital strategies, compelling merchandise, and in-store presentation moving forward. But investors don't know what that cost will be. Analysts are hoping to know more when Cornell speaks to the financial community next week at its Investor Day in New York City. For Nightly Business Report, I'm Courtney Reagan.
The owner of TJ Maxx is following Walmart's lead, raising wages for 500,000 of its employees. In its fourth quarter earnings report, the parent of Marshalls and Home Goods said full-time and part-time hourly employees will earn at least $9 an hour starting in June. Workers who've been with the company for 6 months or more will earn $10 an hour. As for its earnings, the company's overall results topped estimates, and it will hike its dividend to 21 cents a share.
Still ahead, the big problems plaguing our nation's pensions, both private as well as public. The three largest tobacco companies have agreed to resolve pending tobacco lawsuits in Florida. The cases are related to a 1994 class action suit. Reynolds American and Altria will pay $42.5 million, while Lorillard will pay $15 million. Shares of Reynolds and Lorillard rose a fraction. Altria fell just slightly. Big American technology companies may be feeling the fallout from revelations of Western cyber surveillance, this according to a Reuters report. The government of China has now dropped some big-name tech brands like Cisco, Apple, and Intel from its approved list of state purchasers. Eamon Javers has been covering this story since we first learned of the surveillance program and the global reaction. So, Eamon, did Edward Snowden, if anything, give China an excuse to stop using American companies?
Yeah, sure, absolutely, Tyler. I mean, there are a lot of reasons why China might want to stop using some of these American companies and push some of that business to its own domestic industry. But of course, the Snowden disclosures give them a very good reason to do that from China's perspective, from Beijing's perspective. Why import all this gear that might be contaminated with NSA software or hardware or cooperation agreements between those corporations and the NSA? If you can build it at home and buy it at home, it makes a lot more sense for the Chinese. And of course, American companies have a lot to lose in all this.
Absolutely. I mean, it's going to have a big impact on the bottom line, but it seems to me that a lot of it does go to what you were just mentioning, Eamon, and that is that over the past few years, China has really ramped up its focus on creating its own technology companies.
Yeah, that's right. And don't forget, Sue, that this concern goes both ways. American government agencies have had concerns about Huawei and Lenovo software and hardware. They've been very reluctant to use some of those machines in the U.S. government and in high-tech and high-security industries for the same reasons the Chinese may be resisting American equipment. So you have this sort of standoff, but more American companies are selling equipment in China than Chinese companies are selling equipment here at the high end. So that means that those American companies have a lot to lose here. And a lot of that plays into this tension that you're now seeing between the Silicon Valley companies and the U.S. government in the wake of those Snowden disclosures. A bit of a frosty relationship here now, as business is definitely being lost.
Eamon, thank you, as always. Eamon Javers in Washington.
Well, Chesapeake is the latest energy company to cut back because of slumping crude prices, and that is where we begin tonight's market focus. The company reported lower than forecast earnings and said it would cut its rig count and spending this year. The stock today, one of the worst performers in the S&P 500, down 9.5% to $17.98. SodaStream, let's go there. Quarterly profit topping estimates. Lower expenses offset a drop in revenue, but investors couldn't overlook that sales drop, which was mainly due to lower demand for its at-home soda machines in the U.S. Also, a weakening euro to dollar exchange rate hurt revenue. Shares fizzled out, down almost 9% to 17.25. Shares of Lumber Liquidators got hammered after the company revealed it may face criminal charges from the Department of Justice for allegedly importing illegally harvested wood. The chain also said that it will be the subject of a negative profile on an upcoming episode of CBS's 60 Minutes. Adding to the bad news, the hardwood flooring maker's results missed on both the top and bottom lines. Not a good day for Lumber Liquidators. Look there, down $18 a share, Sue, 26% to $50.63.
Yikes. American Express said it will hike interest rates on some of its cards by an average of 2.5 percentage points. It's not yet clear how many customers might be affected by that move, but some reports say more than 1 million cardholders will see rates rise. Shares rose more than 1.5% to $82.17. Southwest Airlines reached an agreement with federal officials early this morning that allows the airliner to keep flying its jets even after missing a mandatory inspection deadline. The Wall Street Journal reports that the FAA is allowing the planes to fly for 5 days while those checks are completed. There are 128 jets in question, roughly 1/5 of that airline's fleet. Shares of Southwest were off almost 3% to $44.12.
Well, as the NASDAQ inches closer to 5,000, it has been 15 years since the index last hit that lofty round number. And while many firms that fueled its rise in 2000 are long gone, others survived, a few with the same chief executives in place. Mary Thompson looks now at those CEO survivors.
NASDAQ 5000, a target a few long-serving CEOs have seen the index hit before. Amazon's Jeff Bezos, Starbucks' Howard Schultz, Cisco's John Chambers, and Oracle's Larry Ellison, all at the controls in 2000, still at the controls today.
The reason why they've lasted is because they've learned to adapt.
They aren't afraid to hire talent to steer the change, as Chambers has done, and they are innovators like Bezos, who's changed and challenged retail, and Schultz, who's changed the way we think about coffee. Ellison changed how corporations buy software, bundling it rather than selling it piecemeal.
Is leadership important? I think it's really important.
These CEOs rare not only because of their long-term success, but because of the long terms they've served their companies. The Conference Board pegs the average tenure of an S&P 500 CEO at 9.7 years. These four have run their companies for 20 years or more, in part because they understand something very important, according to Professor Bill Klepper.
Smart CEOs are constantly looking to not only maintain the current portfolio of offerings, but at the same time look to reinvent what it is they're doing because of what the future holds for them or their customers need.
A serial entrepreneur, Bezos is not afraid of new ventures, even as he maintains a relentless focus on making customers happy.
We have created a lot of shareholder value. We've done it by being consistent, by thinking about the future, trying to put the customer first, trying to invent, and being patient.
That patience paying off for investors who've seen the stock rise over 450% since 2000. Like Bezos, Schultz focuses on the customer and competition. During Schultz's 8-year break as CEO, Starbucks faltered. Returning in 2008, he closed stores, hired from outside, and retrained baristas to make the perfect espresso, a small detail contributing to an over 900% gain in the stock since the crash.
I have tried to build the kind of company that my father never got a chance to work for.
Ellison is chairman now, having stepped aside as CEO last year. Through acquisitions, he transformed Oracle from a database firm into a software giant and remains its key strategic thinker. Still, Oracle's gains since the crash have been muted by the rapidly changing world of tech, which has made for choppy waters for Cisco and Chambers, too. Cisco's stock is down, and some call for Chambers to go. Still, the networking firm survived the crash and remains a leader in a space where past rivals are now gone. For Nightly Business Report, I'm Mary Thompson in New York.
To pensions now. Public and private pension plans have not gone away, of course, but with many people living longer, Both are experiencing funding shortfalls. Joshua Gottbaum is here now to discuss the issue and how it might impact you. He is the former director of the Pension Benefit Guaranty Corporation and is now a guest scholar of economic studies at the Brookings Institute. Welcome. Nice to have you here, Joshua.
Nice to be here.
It's kind of a good news, bad news story, as we said. We are all living longer, but we might outlive those funds if we do indeed are lucky enough to have a pension.
That's right, but I think the most important thing to remember is that we are living longer, we are having healthier lives. The challenge here is that our retirement programs just haven't kept up. So that where companies or governments sponsored pensions, they didn't set aside enough to take this into account. For most of us who don't have pensions, we've got 401ks or IRAs or bank accounts, that responsibility is ours, and most of us have not set aside that. That's the bad news. The good news is that this is not a problem which you have to solve in a day. It wasn't caused in a day, and it can't be solved in a day. This is something which, if we are serious and smart and consistent and don't panic and start setting aside more now for the future, then retirees will have a future.
What is ultimately going to happen, Joshua, if companies or states like New Jersey fail over time to put the required amounts of money in? Governor Christie widely criticized for not living up to a pledge he apparently made some years ago to put the state's pension plan on firmer footing, and now he's back in front of the legislature saying, this time I really, really mean it.
One of the most important things to understand is that cases like Governor Christie and New Jersey are the exception. The vast majority of pension plans put the money aside that they were supposed to. Now, it is the case that they set aside the amount that assumed the stock market would continue to rise. And so, as a result, they are underfunded. A couple of states or municipalities like New Jersey did more than that. They compounded it by not even making those required contributions. So they're kind of behind 2 8 balls. But what's important to remember is 2 things. One is they are the exception. And 2 is if they are serious, if they are consistent, if they start correcting it now, things will end up just fine.
But how much of this depends on the market continuing to perform well? I mean, as you mentioned so aptly, nobody expected 2008 to be as bad as it was or to last as long as it did.
I've had a couple of colleagues who are trying to estimate that. And there's no one who obviously can tell you the answer where the stock market is going to be. If they were, they wouldn't be spending time on the nightly business report. They'd be investing on their own account. But if using relatively conservative estimates of what markets will make over the course of a generation, using relatively conservative estimates, it looks like the shortfall can be made up over time. I have a colleague at the Brookings Institution who looked at retiree health, not retiree pensions, but retiree health, on which there was a shortfall, and it's a very large amount of money in present value. She then went and said, now how much change over time would it take in order to solve the retiree health problem? And what she found is that a less than 1% increase in revenues, that's taxes, or a less than 1% increase in costs would be enough to solve the retiree health problem.
Wow. Okay. Joshua, on that note, we have to leave it there. Thank you so much. Fascinating discussion. Joshua Gottbaum with the Brookings Institute. Ty?
And coming up, going with the grain, cashing in on America's hunger for more protein, which is coming from the most unusual of places.
Americans are on a protein adding craze. They're throwing powder into smoothies and using it on toppings for food. And as Jane Wells tells us, there's one grain in high demand that's packing in that protein.
Darren Goka personifies everything in modern fitness. He does CrossFit, eats paleo, but without the meat. Instead, for muscle recovery and protein, he's turned to alternatives like rice. Rice is the new meat?
I feel better, my body feels better. My recovery is exactly the same.
This is rice and pea.
Rice and pea protein.
David Jano is CEO of Axiom, the largest producer of plant-based proteins in the U.S., cashing in on America's hunger for more protein in our diet. The BBC estimates animal-based whey protein will be a $12 billion global market in 2 years. And Axiom wants to carve out a niche, having figured out how to extract the 8% of protein from a grain of rice.
If you take a scoop of this and you take a scoop of whey protein, you're going to get the same results.
Is this more expensive?
No, it's actually less expensive, and it's also hypoallergenic, it's gluten-free, it's vegan.
Axiom's Arizatine rice protein sells in products sold everywhere from Whole Foods to small stores like the Vitamin Barn in Malibu. Nutribiotics has been using it for the last few years, and rice protein products are now its fastest growing line.
The organic sales since 2011 have increased 204%, and actually last year the sales increased 72%.
Rice protein doesn't cost that much because Axiom uses unsellable broken bits of rice as source material. Annual sales are estimated at $100 million. But with a study in the Nutrition Journal showing no difference in muscle recovery between using whey and rice protein, the market is expanding from the health food crowd to the health club crowd. For Nightly Business Report, Jane Wells, Los Angeles.
That's it for Nightly Business Report. I'm Sue Herrera.
And I'm Tyler Mathisen. Thanks for joining us. We'll see you back here tomorrow.